Good morning, everyone. Welcome to this week's Research Morning Call. This morning, we'll present on the US strategy and stock picks from last week, followed by Singapore Banking Monthly. And there are also several stock counter updates, for example, NVIDIA, Zixin Group, Manulife, US REIT. And following that, we'll have some technical analysis on several stock counters, for example, ETF Monthly, S&P 500, and some Thai SDR stock counters. Then we'll end off the session with SG Weekly, Week 3. This is a disclaimer that all information presented here is not financial advice and it's just for educational purposes. Now I'll hand over the time to Glenn for the US strategy and stock picks portion.
Hey, thanks, Iqban. Yep. So this is just a quick recap, a summary of the US strategy and stock picks that we had last week on last Thursday. Yep. So we'll just briefly go through, our investment themes. We have three of them. First one being the lower than expected rate cuts, and this is particularly affecting the US banks. Now, going to this first slide, we see here it's basically just the Dow Jones US Bank Index, so the US banks' share price performance versus the Fed funds rates. What you can see is that usually the bank's performance does follow the Fed funds rates, because as with a bank, the higher the rates are, the more beneficial it is for them, and you'll see that they perform better, and hence why their share price performs better as well. But what recently we are seeing, at least in the last last year maybe, is that even though rates have been cut, but we are seeing that the bank's share price has actually performed relatively rather well, right? Is done in inverse. And we can see this is mainly from a good set of results that they have had, but also from another factor is that the Trump's win has also benefited the banks. There are two reasons why. First one is that lower than expected rate cuts, which is the theme that we're having, and the second reason is also Trump's preference for deregulation for the banking sector, and in whole, just deregulation. So there's been a lot of talks about this Basel III endgame, which the banks have been very opposed to. They have been trying to appeal against this Basel III endgame, and to really nitpick on all the details that they have. The main thing that they are not satisfied with this Basel III endgame is just that the capital requirements. So Basel III endgame is basically trying to increase the amount of capital that they have to set aside in case of scenarios like what happened with the Silicon Valley Bank. All right, so that's the reason why they are increasing this capital that the banks have set aside. So with Trump's win, although the Fed's Powell himself has said that he will not step down, even though if Trump asks him to step down. So the Feds are quite strict with that, saying that they're not going to move. But everyone, the expectation is that with Trump coming in and this new administration, that there will be more deregulation. So the banks will have more free play with the amount of capital that they have, basically having more capital and being able to benefit from this. So that's also one of the explanations of why bank share price have improved. And with Trump coming in, we do expect that this will benefit the banks like quite a bit, because they will be able to have more freedom in spending capital instead of having it locked away for a rainy day per se. Now let's move on to the bank's earnings. So this is basically just the 3Q or third quarter results, bank's results. So we have seen that net interest income has continued to decline, mainly due to the higher cost of funds and as well as asset yield growth stagnation. And the non-interest income was the main driver for the banks, and this is mainly coming from the continued recovery in the investment banking. So you see this red bar, the first red box here. Investment banking has really been the highlight for the banks and what has been propping their earnings up. Provisions have also increased slightly. This is to be expected from the higher credit card charge-offs, but it's more of a return to a normalized level. I'll touch upon that more in detail in the later slide. As for the PATMI or earnings-wise, it was quite subdued. It wasn't as strong as it was, but this is also to be expected because they are returning to a more normalized net interest income level, which the banks really largely depend on. Right. So now let's move on to the next slide. Yeah, for this chart shows the US banks' net interest income and net interest margins versus the Fed rates. So if you look at it industry-wise, the net interest margins have increased by 6 basis points from the last quarter after declining by 14 basis points during the prior 3 quarters. So this is the first increase that we have seen in basically a year, right? The NIM is also just below its pre-pandemic average of 3.25%. This is very interesting because while rates have been cut or at least have been stagnant for that quarter, we have seen the net interest margins and net interest income inch up. And this was really driven by all size of cohorts in the third quarter and by higher consumer loan income at the largest banks, as well as higher real estate loan income for the rest of the industry. Now, moving on to the next slide, we'll better explain why the bank's net interest margins have actually improved. So one of the reasons, at least for the last almost 1.5 years, why the banks have been having this decline in net interest margins is because they're hurting from the higher for longer rates, as the asset yield growth have greatly outpaced the cost of funds after the initial positive effect that they had. And so this is quite positive because currently in the last quarter, we have seen that the loan yields have finally outpaced the deposit cost. So loan yields increased by 13 basis points, while the deposit cost only increased by 8 basis points. And this drove the increase in the industry's net interest margin for the quarter. So this is the first time that the loan yields have increased faster than deposit costs since the second quarter of 2023. So almost 1.5 years of this decline in net interest margins. Going forward into 2025, we do expect that this will continue, at least where the loan yields will continue to outpace the deposit costs. So we could see further upside to the bank's net interest margins and hopefully some positive news for the net interest income as well. Because in the next slide, we will see the driving factor, at least for the bank's net interest income, which would be the loans growth. This chart just shows the bank's loans growth versus the nominal GDP growth. So we don't really want the loans growth to surpass the GDP growth, because that will just mean that the consumers are over borrowing and banks are over lending. So it's not very healthy, and this is one of the indicators that we use to see if a recession is coming. So currently, while the GDP growth has been a bit of a decline, but while loans growth is more of an increase, it's still below, there's still quite a big spread. And we do see this turn around as the rates start to get cut. So consumers are more used to these high rates, and also the lower rates are inviting more consumers and more borrowers into the market. The largest quarterly growth that we have seen are from the non-depository financial institutions, and also consumer loans have also driven the increase, and this is mainly coming from the credit card loans. Moving into this year, the rest of the year, we believe that the continuation of this loans growth will continue. So as more rates get cut, and this will be beneficial for the banks as it will positively impact their net interest income. Now, with the growing loans growth, you would expect that the net charge-offs, as well as the past due and non-accrual rates, will also increase, and it has increased. So it has risen by 6 basis points quarter on quarter, but the positive point is that it's still below the pre-pandemic levels that we have seen previously. So the main increase and the largest increase, I think, was from the credit card charge-offs, and this is also sort of expected, as it is sort of a return to normal, and also credit card loans are the ones that are driving the loans growth increase. So, but however, it's still below the pre-pandemic levels, and the banks have been watching out for this, as this has been in the news for quite some time. So going forward, we believe that this will be for the past due and charge-off rates. It's more of, again, a return to normal. So nothing to worry about for the banks. And going to the rest of the year, this will be something to watch out for, to see if the banks are really just over-lending it to non-desirable sort of consumers. Now that's all I have for the banking sector. I'll now hand it back to Iqbal for the semicons. Thanks.
Thanks, Glenn. Now, over to our next team for semicons. We do think there is room for growth. As you can see in this chart, this is the worldwide semiconductor revenue growth. As you can see, all the way back from 2003, semicon revenue growth has been in peaks and troughs. The blue line shows the trailing 3 months, while the yellow line shows the trailing 12 months of year-on-year growth percentage. For last year itself, we did see a big ramp up in semicons revenue growth, because hyperscalers hyperscalers have been ramping up their capex on data centers. So semicons experience a very big jump in revenue growth. We do still see a short runway for room for growth in the semiconductor industry because Nvidia's Blackwell chip is in full production, and we think that it will start shipments this year. And we do think that the shipments for Blackwell chips will continue all the way to around the middle of this year. And from there, then we will have to look out more for any more developments itself. We have a positive outlook for semicons because as you can see in this chart itself, semicons had experienced very strong growth in both revenue and PATMI for the past year. And for the outlook for the quarter ending December, management has also provided a positive outlook. We cover AMD and NVIDIA within the processor category. And for Broadcom itself, it has received quite a lot of attention lately. We don't cover Broadcom. However, it has provided very strong guidance in its AI segment all the way till 2027. That's why investors has been very positive in this segment because the outlook provided by the management has a long runway ahead. Management for Broadcom do believe that its AI segment will grow because will grow from hyperscalers building their own custom AI accelerator chips, also known as XPUs. For NVIDIA and AMD, I will cover in the next two slides. For AMD itself, as you can see in 2023 itself, it experienced weakness in its PC segment. Hence, that experienced the negative last 12 months growth as seen in the yellow line. However, in 2024, this last 12 months growth entered into the positive region because of the increasing MI300X GPU demand from hyperscalers such as Microsoft, Meta, and Oracle. And it also increased its market share within the CPU processor segment from its EPYC data centers. So it increased its CPU market share from Intel, and it also increased its PC CPU market share from Intel as well. So going forward, we have a buy recommendation because we do see continued growth in demand for the AI chips, and we believe it will benefit AMD because the data center segment represents more than 50% of its revenue. So we think growth will come from its EPYC CPU servers as well as its MI300X GPU chips. For the next slide, we will present on NVIDIA. As you can see, there's a plateau in its growth margin because Blackwell is in full production. So management has guided that the production of Blackwell will incur higher costs in the data center segment. However, we do think that demand will be strong for Blackwell itself because hyperscalers have been ramping up their capex with for its AI capex in the data center segment. And because Blackwell is the most advanced AI GPU in the market, it is around 1.5 to 2 times better than Hopper, which is its predecessor. So we do think that hyperscalers will want to invest in the best kind of infrastructure chips to stay ahead of the competition. And hence we do think that the shipments of Blackwell will bring in further revenue growth for NVIDIA itself. We have an accumulate recommendation for NVIDIA because the price has ran up quite a lot in recent months, and we do see some near-term risk because of Trump's inauguration, and we think that he will bring in some tariffs policies. However, we think that it won't be as severe as 2018 because NVIDIA has less exposure to China right now compared to 2018. As for some updates for NVIDIA's CES 2025 event itself, they launched several AI chips, and I think one of the most significant one is their announcement of their partnership with Toyota, and also they have talked about their automotive segment. As you can see, the automotive segment is in red. Right now its revenue is around 1 billion, and NVIDIA guided that its revenue will increase by 5x from FY24 to FY26. So from $1 billion, it will increase to $5 billion in FY26 itself. However, we do think that this $5 billion will still make up a small segment of its revenue because we do think that FY26 revenue will reach close to 200 billion, as seen in the bottom left chart itself, because there is still very strong growth from data center segment itself. NVIDIA also launched its new graphic card, the GeForce RTX 50 series. However, we don't think that this new graphic cards for PC will bring in a very material impact, because previously during its launch of the RTX 40 series, it only brought in a growth of -27 year-on-year growth and 15% year-on-year growth for the following year, for ever since the launch of its RTX 40 series. So we don't think it will have a very material impact on the PC segment. They have also launched other AI chips, for example, the GP10 chips, which will be used in Project Digit's desktop for researchers, and also debuted its open model license Cosmos platform. However, this too represents a small segment in the revenue, so we will just have to keep a lookout for these two small segments. Our outlook for NVIDIA is that our TP is unchanged, and we maintain accumulate, because we don't think that there is very material impact from the launch of the products itself. Yeah, so that's all for my part. I'll hand over the time now to Helena. Thanks.
Thank you, Igban. So now I'll be moving on to our third investment strategy, which is cloud computing and how the AI boom has been fueling it. So cloud computing has been a very prominent topic in the recent years. We see for sure there's an increasing adoption across the workplaces. So looking at the public cloud revenue, which we calculate by aggregating the cloud revenue of Microsoft, Google, and Amazon together, we see a rapid growth trajectory projecting at around 22.3% CAGR over the next 2 years. The key growth driver is still the ongoing digital transformation as companies, they start to migrate their workload from on-premise to cloud. It is almost a sure yes now to most companies, whether they want to move their data to cloud, because it brings in just way too many benefits. So it's really just a matter of time, how long it would take. And right now we're still at the very beginning of the trend, because we still have more than 75% of the IT spend still on premise. Looking at the CapEx spending, next slide, please. So the big tech company like Microsoft, Amazon, and Alphabet, they have increased their spending on AI infrastructure in order to meet up with the rising computing demand since the second half of 2023. In the last quarter, the CapEx went up almost 80% year-on-year. So they're heavily investing to build out new data centers, as well as procuring specialized GPUs in order to train and run their AI models. CapEx have dropped significantly actually in 2022. This is when the enterprises, they start reducing their IT spend and optimizing their resources due to a lot of macro uncertainties, especially related to COVID. But now for sure we see an uptrend, and this does not seem to be slowing down. All three companies have indicated that their CapEx will continue to grow in 2025. So higher CapEx spend by cloud providers will definitely lead to higher revenue due to infrastructure capacity expansion and enhanced capabilities. So the three companies we're going to be talking about when it comes to cloud, the first one is going to be Alphabet. Next slide, please. So for Alphabet, their cloud segment surged 35% year-on-year in the last quarter. This is their largest growth in the last 2 years. So it's really their suite of entire AI power solution that's attracting new consumers and supporting larger deal wins. Their cloud operating margin increased as well from 11% to 17% in just 1 quarter. We definitely anticipate continuous sequential growth for cloud due to the advancement of AI. So another big arm that Alphabet has would be their advertising. Advertising grew really resilient as well. It benefited from some election-related political spending towards the end of the third quarter. Also, their AI overview, which is powered by Gemini, they're seeing it as a main product that drives growth, because they start seeing users now asking deeper and more complex questions, and this will potentially create more opportunities for future monetization. Alphabet is also, their commentary still on maintaining costs. Their operating expense growth remain very, very low at only 5% year-on-year. So this will imply more margin upside. So overall, we have a buy rating with a target price of $340. Moving on to the next company, that will be Amazon. So Amazon, very similar story, experiencing very strong growth in cloud. It grew, the last quarter, it grew like the fastest quarter in the last 7 quarters. So this growth also fueled by consumers expanding their cloud presence. And AWS also is a very high margin business. So growth in that will boost Amazon's overall operating margin as well. So we expect AWS growth to accelerate and in turn to push up the company's overall margin. And another big arm that Amazon has will be their e-commerce. E-commerce recently, there's a lot of great price sensitivity among consumers. That means we see a short trend of consumers looking for cheaper deals or discounted deals. But with that being said, their retail services are still seeing very solid traction. This is because they have a continued focus on cost management. They also try to shift towards lower ASP products and essential categories in order to align with consumers' changing preference. They're also trying to grow their subscription revenue through a lot of discounted provided for their members, and they're trying to grow their advertising growth. So this is like a pretty smart move of how they're trying to gain traction, even though the market was generally not doing well. So overall, we have a very positive buy recommendation for Amazon with a target price of $200. The last company I want to share would be Microsoft on cloud. So Microsoft Cloud, same story, also grew very rapidly. Even though on the graph we see it was actually going down a little bit. This is because recently they changed their way of recognizing the revenue. So their cloud revenue as a result has been adjusted down. So if we were to calculate the growth compared to previous result, also adjusted down, their growth was actually above 30% year on year. On top of their cloud services, we also see pretty strong demand for their Office 365, which is fueled by the expansion in consumer base and higher average revenue per user. So overall, we have a cumulative rating with a target price of $480. So I guess one common question that people will ask would be, how are these three cloud companies really differentiated in terms of being a cloud provider? We would say Alphabet, they came into the race much later than Amazon and Microsoft, so they're not really exactly comparable in terms of scale. But for Amazon and Microsoft, Amazon started the business 4 years ahead of Microsoft, so it still remains the market leader for now. It provides a more advanced but complex platform. So it's best if you're looking for a breadth of services and scalability. But Microsoft, on the other hand, it's very ideal for enterprises already using the Microsoft ecosystem because you can really just seamlessly integrate with your Office 365 Dynamics and all the on-premise Windows Server environment. So Microsoft's cloud is consistently increasing faster than AWS, given AWS base is bigger. And also its clients are mostly startups and tech companies. Most of them are pioneers in adopting cloud services. So in this space, it's really just more saturated when you compare to Microsoft's target, which is enterprises already using the Microsoft ecosystem, and they're coming slightly late to the game. But with that being said, it doesn't mean AWS won't be able to compete with Microsoft because they have the most tech-savvy client. And in terms of CSP, there's quite a bit of stickiness when it comes to that because you can always retrain your data with another CSP, but there's going to be a lot of cultural resistance. So once you pick which cloud provider you use, generally people don't like to easily switch it. Yeah, so that's all from the cloud sector. Now I pass my time to Zane.
Thanks, Helena. Good morning, everyone. I'll talk about some of the seasonality trends during the first year of a presidential cycle, as well as our technical outlook for S&P and the Nasdaq. So, first slide is talking about based on history, we're likely to see some lower returns during a Democrat to Republican transition. So, the blue bars actually represent the historical returns 1 month to 1 year post-election when the Democrats stay in power. So usually they start off quite slow with a negative return of about 1% in the first month. However, it increases over time towards about 8% return 1 year after election. However, when it changes from a Democrat to Republican, it's the opposite. Typically, it starts off with about a 2% return in the first month, and subsequently the returns diminish over time with a possible about negative 2% returns 1 year post-election. Yeah, so this actually just shows the contrasting returns when it changes from a Democrat to a Republican administration. Next slide. Next one is talking about historical returns following a Republican sweep. So this is a scenario when the Republicans take control of the presidency, the House, as well as the Senate. There have been 6 Republican sweeps in history, including the election that occurred last year. So when you look at the historical returns for S&P 1 month to 1 year post-election, At a 1 month mark, it's about a 2.2% gain on average. 3 months and 6 months, it hovers around the mid 4%. As for 1 year post-election, it's about a 0.5% return for S&P 500. Next slide. Next one is talking about this seasonal performance for first quarter in the first year of a presidential cycle. So I think we're looking at historically it's been quite average for the first quarter. So in January, it's about a 0.7% return. February is about negative 1.6%, and March is about a positive 0.6%. When we look at the blue bars, and the orange line is talking about it shows the percentage of the months, the probability of the month being in the positive. So for January and March, it's still over 50%, but in February, it looks like there could be some weakness with a less than 50% chance of February being the green when we look at seasonals. Next slide. Next slide. Yeah, so this our outlook for the Nasdaq based on technicals. So currently, we are seeing a bit of a slight weakness because of a breakdown in the short-term trendline support in black. So with that, we are just seeing some consolidation above the 19,100 level. I think we could just see some prolonged consolidation for this quarter with our first quarter target at about 18,700 to about 20,000, this area over here. Yeah, next slide. Next one for outlook for S&P, currently it's in this consolidation of a descending triangle highlighted in blue. So it's just with the key neckline resistance about 5,855 level. Also seeing some short-term weakness similar to Nasdaq where the price action showed a breakdown of a short-term trendline support. So it's just moving sideways for the time being. I think we could see just a bit more of this consolidation going forward in the first quarter with the target range about 5,800 to about 6,000. Next slide. Yeah, so I think I'll just hand over time next to Glenn to cover the Singapore banking market. Thanks.
Hey, thanks, Zane. Yep. So we'll be also doing the banking monthly. Now moving on to the first slide that I have here. Yeah, it's been showing the usual, Singapore interest rates as well as the Hong Kong interest rates versus the Fed funds rates. So for the Singapore interest rates or the 3-month SORA, it was down 15 basis points to 3.14%, and this is the lowest that we have seen it since January of 2023. While year on year it also fell 60 basis points, and this is also the largest year-on-year decline we have seen since March 2021. Yeah, we do expect the 3-month SORA to continue declining as more Fed rates come in. Yeah, so this is sort of expected. For the Hong Kong rates, it did really a bit of a surprise. It inched up in December, but if you look at it year on year, it was also down by 102 basis points. If you look at the chart, it's a bit more random, like where the Hong Kong interest rates goes, but it does also follow the Fed funds rates. So we do expect that to also creep down once the more rate cuts come in. So going to 2025, the rest of this year, we feel that the rates will continue to decline. Now for the next slide, which is some positive news for the Singapore banking sector, is that the loans growth has reached a 26-month high. It has hit 3.3% year on year in November. So this is I think the first time we have seen it go on above 3% in quite a while. And this is also continued from the increase of 2.7% the month before. We do expect for 2024 that it will still be around this low single digit kind of growth. And as the loans growth is expected to recover further in the rest of this year as rate cuts come in, more rate cuts come in. For the bank's guidance for loans growth they only given for 2024, they're also expecting around low single digit. I think the main contributor to loans growth was the building and construction segment, which is the single largest business segment. It rose by 4.7%. While the manufacturing segment was still quite lackluster, it's still in a decline. It fell by 7% in November. For consumer loans, the housing loans have always been sort of a steady rock for loans growth. Right? It's has always been hovering around this 2+% kind of range, and no difference in November. As for the total deposits and balances, it has risen by 5.2% year on year in November. And more interestingly, the CASA, however, has fallen slightly. So it's gone back to the previous levels of 18.3%. Why we always have this deposits and CASA is because the CASA is very important for the banks, as it sort of explains, it can sort of foretell the bank's funding costs, because CASA it's almost free funding for the banks, like 0% kind of interest for deposits. So for going forward into the future, we expect that the CASA ratio will increase as there are higher sort of interest kind of fixed deposits, which we have seen, in 2023 and 2024 start to mature, and now there's less options out there, for this kind of high interest, low risk deposits. So this will all mature, and then these funds will get pushed back to CASA because there's not really much option left for the investors. Or the other option, of course, is to go into the fee income, which the banks have been benefiting from largely for the last 1 year. Now, moving on to the next slide, we're looking at the SGX market statistics. So we'll look at two of the main figures, which is the SDAV, the Securities Daily Average Volume, as well as the DDAV, the Derivatives Daily Average Volume. So both have grown in December, but it has grown at a much slower pace as compared to the rest of the half year. So compared to August to November, it was like 20 to 60% kind of growth, year-on-year growth. However, in December, it has sort of slowed off. You're only seeing 2% for the SDAV, whereas the DDAV only grew by 5%. As for the VIX, which is the market index that we use to look at the implied volatility of the S&P 500, it was also quite stable at 15.9, similar to that of the previous month. The volatility has sort of dipped after the US elections and has somewhat returned to this more normalized level. As for the top 4 equity index futures turnover, it rose by 4%, and this is mainly coming from the FTSE China A50 index futures trading volumes. So if you look at it as a whole, for second half, this is a very good indicator or predictor of SGX's performance, because most of the revenue comes from both from the volumes. So you look at second half in a whole, the SDAV was up 32%. As this securities market was buoyed by the increased participation as the Singapore's benchmark stock index outperformed ASEAN. There was also higher volatility in August from the yen carry trade, as well as in November from the US elections, which has boosted the volumes for the SDAV. And in addition, also their DDAV for the second half was up 21% as the Fed's cut rates and also China's policymakers also introduced new stimulus measures. So all these, contributed to these two volumes growing a lot. And what does this mean for SGX? It means that we do expect this continued recovery in their equities cash as well as equities derivatives revenue for the first half of their financial year 2025, as the trading volume have improved. And we have done some rough calculations, and we think that these volumes could increase their revenue, their equities line revenue, by 16% year-on-year, and this could add around 50 million to their revenue. So for those who are interested in SGX, they will be announcing their first half FY25 results before the market opens on 6 February of 2025, so in a couple of weeks' time. Now moving on to the next slide, we're looking at the Singapore Bank's performance. So for December-wise, it was quite muted. They only rose 2%. But if you look at it as a whole year in 2024, the bank's share price has registered record increase of 34%. DBS was the main leader. It rose by 45%, while OCBC and UOB rose similarly by 28%. There are a couple of reasons for this strong performance, at least for the year of 2024, and that's mainly due to a strong set of results that they had for the first 9 months of the year, and also compounded by a Trump win, which has lowered the rate cut expectations. And we expect that the bank's net interest income and net interest margins levels will continue to either maybe inch up slightly or just remain flat. And the main kicker coming in, the main boost for them would be the continued fee income recovery that we have seen going into the rest of the year, going to the rest of this year, as well as into the fourth quarter's results, which we will be able to see quite soon. And last but not least, for the banks, I think one of the main things the investors are looking at is that their excess capital of $2 to $4 billion has hinted at, has prompted management, to actively manage this excess capital. So this could mean two things: is share buybacks or higher dividends. So both could come in, or one or the other. Now moving on to the next slide, we look at we have put in this sort of a topical subject, and the main thing is that we believe that the steepening yield curve could benefit banks. So I think there was also a question for the reasons, asking why is the US 10-year Treasury yield increasing. So this chart doesn't really explain it, but maybe I think the few explanations are, we do expect there's higher inflation. US economy is also doing quite strong, and also the expectations of less Fed cuts have all contributed to the increasing US 10-year yield. And what does this mean is that, we have seen an inverted yield curve where the short-term bonds have risen above those on the long-term bonds of the same credit quality. So that's why we get this inversion. But what we have seen recently is that where the US 10-year Treasury, the yield has increased above the US the short-term ones, which is the 1 year we're using in this graph here, and it has returned to a more normalized level and resulted in this steepening of the yield curve. So why is this benefiting the banks, you might ask? It benefits the banks as the banks typically borrow money at short-term rates, and lend at rather long-term rates. And this means that they can earn more interest on loans than deposits, and this will boost both their net interest income as well as net interest margins. Steeper yield curve could also reduce the bank's interest rate risk, as the spread between the short-term and the long-term rates provides a buffer against the sudden changes in interest rates. So all in, we believe that going forward with the steepening yield curve, the banks are able to really benefit the net interest margins quite greatly, and this will help to boost their earnings and bottom line. Now, moving on to my last slide here, just to wrap it all up, we do maintain overweight on the banking sector. The bank's share prices have surged by 34% from a strong set of results as well as lower rate cut expectations. And also with lower rate cut expectations going into the rest of this year in 2025 and a rising yield curve, the banks can earn more interest on loans than deposits, which will boost both their net interest income and net interest margins. And furthermore, the other segments of the banks also do well. With the rise in trading volumes, the capital markets have become more buoyant, and the trading income could be further benefited. And last but not least, there are continued double-digit growth in in fee income, as well as the loan growth recovery will also contribute to the bank's earnings increasing. And for investors and shareholders, the further upside to dividends, as well as the possibility of share buybacks from their excess capitals of 2 to 4 billion will be a positive sign. So that's all I have for the banking sector. I'll now hand it over to Miao. Thank you.
Yeah, thanks, Glenn. Next slide, please. Yeah, so Zixin is tapping into a new revenue stream by transferring agricultural waste, such as the sweet potato peels, stems, and also the leaves, into feedstock for animal feed. And the company recently secured its first order, valued at RMB 3.2 million, which is equivalent to around 0.6 million Sing, for the chicken breeder farm in Liancheng County. And the initial order was secured after a 2 months trial feeding period, and during which specific parameters was evaluated, including the weight, appearances, and also the size. And Zixin estimated that incorporating the probiotics formula into the livestock will reduce the breeding time by around 10%. So originally it's 6 months, now it takes like 5 months. And the formula is designed to eliminate residual hormones and also antibiotics in the livestock, thus improving survival rate and also enhancing the meat quality. And Chinese government has also introduced very strict regulation on the antibiotics usage, aiming that at least 65% of the breeders in China should comply with the standard by 2030. As a result, we anticipate strong future demand for Zixin for their probiotics formula. And currently, Zixin utilizes only the sweet potato peels as the raw material for the animal feed production. And each acre of the farmland is estimated to yield around 3 tons of the sweet potato. And with only 25% of the sweet potato, which their peels can be converted into the animal feed. However, revenue will be very constrained due to the limited supply of the free and wasted peels, thus requiring Zixin to outsource collection of the additional raw material from the third parties at a cost. And with the introduction of the sweet potato stems as a feedstock in 2026, we anticipate significant growth in sales. An acre of the farmland can yield up to 8 times more sweet potato stem than the peels, thus providing Zixin an opportunity to scale their production and expand the livestock sector. to somewhere like such as the pig farming instead of chicken. And this marks as a turning point for Zixin, and we believe eventually the sales for animal feed would account for more than 30% of the total revenue from FY28 onwards. And we expect customer base to expand rapidly in the upcoming financial year, with the projected sales reaching around 30 million RMB. Given the margin of around 20%, which is higher than the industry average, we estimate PATME would increase by at least 500K in FY26. Yeah, so here are some photos of the animal feed production factory. And on the right is their end product. And the bottom left is the animal feed during fermentation. Yeah, so we maintain a buy recommendation with unchanged TP of 0.056. And Zixin currently holds cash of 136 million, which is around 25 million Sing. This is making up to around 40% of their market cap. Yeah, that's all for me. I'll hand over to Darren for Manulife US REIT. Thank you.
Yeah, thanks, Mel. Yeah, just a quick one on Manulife US REIT update. So they came out with their portfolio valuations update for year end 2024. So it was 9.3% down. So this is an improvement from more than 20% decline in 2023 year ends portfolio valuations exercise. So the main factors were higher discount rates and higher terminal cap rates used, as well as weak leasing in some of the sub markets. So for discount rates, it was a weighted average 50 basis points down. So some of the stronger sub markets, like for Georgia, for instance, the cap rates were flat and discount rates were also flat. So the recovery for the US office sector is really different across all the different sub markets. Yeah, so I have a picture on the right. So that just shows the valuation of their assets in the different tranches. So tranche 1 was down 15.3%, so that's the weakest, and their strongest tranche 3 with Georgia asset Phillips, which is their best asset, which is one of the two which had some slight portfolio valuation gains this year. Yeah, so 65% of the valuation decline was mainly due to the rate expansion, while the remaining 35% was due to weaker cash flow assumptions from the weaker leasing. Yeah, and just a reminder that because they did not hit their 31st December 2024 target of 230 million, so that's a soft target, a divestment target. So they have already paid $2.3 million for that. Because right now they are at about 110 million from the divestment of capital. So they still have another about 200 million plus to hit their 328 million target by June 2025. Yeah, so that is as part of the recapitalization plan. So as a result of this portfolio valuation decline, their leverage is now at 61%. And like I mentioned, the fact that the recovery is very different across sub-markets. So right now, the weakest sub-markets are Washington, D.C., because the federal government, they have not mandated back to office. So most of the employees are still working from home. So that is a huge factor for Washington, D.C.'s weakness. And for LA, management, they mentioned that there is leasing demand in LA, but the fact that the rents are low and the rents have not increased for 10 over years, so which is why also the rates, discount rates, external cap rates keep expanding for LA as well. So that is a weak market, and the TI, the tenant improvements are also very high for LA. Management, they mentioned about 150 to 180 dollars per square foot of tenant incentives. Yeah, so right now the weakness is also driven by the continued loan. Basically there's no loans available or very limited loans available for multi-tenanted office property. So that will continue to be weak. But once that comes back, then we can expect some recovery in the US office market. Yeah, so that's all for the quick update on Manulife US REIT. I'll hand over the time to Zane. Thanks.
Thanks, Darren. I'll move on to the technicals. Yeah, so first one is on the S&P 500 chart. Last Friday, we saw a retest of the key 5,830 support level again. Then for the whole week itself, S&P 500 was down 1.9%. So I think if we do see this key support being breached, we are likely to see some further weakness ahead with the next support level at 5,760. and current resistance area is from 5,910 to 6,000 area. Next slide. And next one, we have our ETF monthly for December. So we titled it Gold Set to Outperform the Other Asset Classes. So in December, most of the asset classes were in the red. Biggest loser was actually the ETF tracking oil, which was down 8.4%. So those in the green are Singapore equities, which was up 0.8%, and Hang Seng Index, which was up 4.9%. In terms of the current trends of most of the asset classes are in the range consolidation, which are S&P 500, gold, oil, Bitcoin, and Hang Seng Index. SGS Treasury bonds are in the downtrend, and Singapore equities are in an uptrend. In terms of outlook for this month, we expect most of the asset classes to actually pull back, which are S&P 500, US Treasury bonds, Bitcoin, and Hang Seng Index. We expect gold to outperform the rest with a breakout of its current consolidation. And oil, as for oil and Singapore equities, we do see some sideways consolidation in January. Next slide. So first chart is for the S&P 500 ETF VOO. So looking in terms of the chart, some weakness recently with the breakdown of a short-term uptrend support line. With that, we could see some further pullback towards the next key support area, which is about 514 to 526 area. So that could mean about 2% downside from the current levels. Next slide. The next one is the IEF, the 7 to 10 year Treasury bond ETF. So with that, recent price action has been quite weak with a breakdown of the upward support line and also below a horizontal support level at $92.50. So I think we could see some further pullback towards the next support area closer to about 88.50 to 89.50 area. Yeah, so that's for the we could see some further weakness ahead for the IEF. Next slide. Next one is the Gold Mini Shares Trust GLDM. So for this, I think we are seeing some sort of a consolidation in the ascending triangle formation, higher lows, same highs at around $53.70. I think if it's possible, we see a breakout of this consolidation to actually retest the swing high at about 55.30. So we could possibly see some upside for this GLDM this month. Next slide. Next one is the oil and gas exploration production ETF XOP. So looking at the chart, it's still quite choppy. Still finding support at 125, the key support level, but just trading sideways. We expect resistance about 140, which was a recent breakdown level. So I think we could see some sort of a sideways kind of price action with price likely hold above 134 for this month. Next slide. And next one is the Bitcoin Treasury ETF BITO. So for this, we are just seeing some sideways range consolidation, but a bit of weakness since price actually couldn't hold above the 25, I think it was $25 level around there. So I think if it does break down the key support level at $22.20, we could see some slight weakness ahead, maybe closer towards $20.30 as the next support level. Next slide. As for Singapore Equities ETF ES3, I think generally it's just a bit of a range consolidation currently at the top end of the main uptrend channel highlighted in blue. So I think we are likely to see some sort of consolidation taking place this month with support level at about $3.80 as the first support level. Yeah, and then some resistance from $3.90 to $4. Next slide. And next one is the Hang Seng China Enterprises Index ETF 2828. So for this, I think we are seeing some sideways consolidation, but I think some weakness going ahead is just I think the 69 close to a 69 Hong Kong dollars level, which was a previous support, has turned into a resistance. So a bit of a lower high being formed, and just currently is doing a retest of the swing low. The $75 level has become resistance. So currently is doing a retest of around the $67 to $69 support area. So I think if we do see this level not being able to hold as support, we could see some further price weakness ahead for this ETF. Next slide. Next one, we have our Thai SDR money for December. We titled it Kasikorn Bank set to continue its uptrend. So for the performance of the different various SDRs in December, I think was quite mixed. The biggest loser was actually CPO, which tumbled 8.9%, and Siam Cement, which was down 8.4% as well. The gainers were Kasikorn Bank, Advanced Info Service, and Delta Electronics, with the top gainer being Kasikorn Bank, which was up 3.3%. Overall, for the full year 2024 performance, the top gainer was actually Delta Electronics, which was up 74%. The top loser was Siam Cement, which was down 43%. In terms of current trends, I think it's quite mixed as well. For Airports of Thailand, Advanced Info Service and Delta Electronics are in the range consolidation. CPO, PTT, Gulf Energy, and Siam Cement are in the downtrend. And Kasikorn Bank is the one currently still in an uptrend. For our outlook for this month, we expect some price weakness for Airports of Thailand, CPO, PTT, and Siam Cement. Then for Gulf Energy, we do expect to see a bit of a slight rebound. And Kasikorn Bank, we expect the price to break out of its current consolidation and continue its uptrend. For Advanced Info Service and Delta Electronics, we see some sideways consolidation going ahead. Next slide. So first up, for Airports of Thailand, I think currently it's just still kept in a bit of a consolidation with support at around the $57.60 level. But still a bit of weakness overall as lower highs have been formed since about October last year. I think we just could see still a bit of a consolidation going on, or further weakness if it does breach this key support level at around 57.60. Next slide. Next one is for CPO. CPO, I think we've seen a bit of a price weakness in December with a breakdown of a range consolidation. So currently, just trading a bit sideways, but if it fails to hold the support level at about 53.50, I think we could see some further weakness here, closer to the near the 49.70, the next key support level. Next slide. Next one is PDT. I think overall it's still looking quite weak as it's just trading along a downwards resistance line. We could see some further price weakness ahead. Currently it's the trend line resistance. So potentially you could see a retest of the recent swing low that's about 116.60 about there. Next slide. And for Gulf Energy, I think it's just consolidating in this downtrend channel over here highlighted in blue. But it's overall, I think we could expect some slight rebound this month. It's a retest of a previous horizontal resistance. That's about around 56.80 level, and that's confirmed the downtrend channel support as well. So yeah, we could see some slight rebound towards the 61 area, which is a support breakdown recently. Yeah. Next slide. Next one is Kasikorn Bank. I think it has one of the bullish chart compared to all the other SERs. So just consolidating in this bullish ascending triangle formation, higher lows, but the same with the neckline resistance at about $158.50. So I think possibly we could see a breakout of this consolidation this month, and it could just go to the higher highs towards like 165 as the next possible resistance. Yeah. Next slide. Next one, Siam Cement, still generally the one of the weakest counters, just with a breakdown in this December. So just trading, doing a retest of the descending broadening wedge trend line again at about 154. Yeah, so if it fails to hold this level, I think we could see some further downside towards like 142.50, which is a previous support level, I think all the way back in 2010. Yeah, next slide. And for Advanced Info Service, I think it's just doing a bit of a range consolidation, mainly between like 267 to about 299. So I think that will still continue for a while. So we expect just this sideways to continue on in January. Next slide. Then for Delta Electronics, the chart is actually quite similar to Advanced Info Service earlier on. Just in a sideways consolidation between 141 to 173. So we expect some sideways to just continue on in January. Next slide. Yeah, so we'll have a tanker sell for Singpost at $54.5 cents, and take profit levels at 50.5 cents as well as 48.5 cents respectively. Stop loss at 56 cents, and last close was 54 cents on Friday. So looking in terms of the chart, this 55 cents level is a key level because previously back in October to December last year, this was a resistance, then turned into support. And following which there was a gap down and it did a retest of this level. So previous support turned into a resistance as price was unable to get above it. And there was a couple with bearish divergence on MACD where just making lower highs while price was making a higher high. So a couple of bearish indicators. I think we could see the price actually pull back towards the take profit level 1, this support level, which held the price since October last year, and then a possible lower support level at 48.5 cents. Next slide. And next one, technical sell for Franken at $1.16, take profit levels at $1.08 and $1.03 respectively, stop loss at $1.19. Last close was $1.12 on Friday. So also price weakness shown on the chart with it facing resistance along the blue color short-term downwards resistance line. And the 116 to 119 area is also a previous support area from November last year that has turned into a resistance with the ongoing downtrend. So we expect the price to actually pull back further to do a possible retest of the $1.08 swing low and maybe even lower to test the $1.03 next support level with the MACD below the 0 line further supporting the weakness as well. Next slide. Yeah, so this is just a table to summarize the trades initiated earlier. So for SingPost, it's currently up about 0.9%, and for Franken, it's up about 3.4%. So that's all from my part. I'll hand over time to Paul to talk about the weekly. Thanks.
Yeah, thanks, Zane. I'll move on to just a weekly macro. Next slide. Just run through some of the key macro data that we received for last week. In Singapore, we got some numbers on construction contracts awarded. So this is a compilation of construction award by private and public sector. The monthly numbers are usually very volatile. It was down 20%, but again, 1 month can be up 20, 1 month can be 30. So, but if you take the trailing 12 months, that means the past 12 months total, construction is still very buoyant. It's up almost 30% to 43 billion. It's a record number. So basically, there's a 10 billion jump over the past 12 months in terms of contracts awarded. This is just SBS rail ridership, still sluggish. The next one is just the exports. We usually just to get a flavor of what's happening globally on exports. So Korean, Taiwan exports basically stable, basically healthy. We're not sure whether how much is this due to stocking up ahead of the new US administration, if they were to impose tariffs. So we're not clear of that. The big news last week was the US payrolls. It was 256, much higher than the 133. Usually they always revise it lower, but anyway, the reason why it did so well was due to retail hiring. It was almost a 2-year high. Not sure why there's such a big jump in retail. Unemployment rate was slightly lower. Next slide. Move on to our usual tactical view. So how we see the market in a very short-term basis. So we saw a lot of questions on the bond news. So there's basically record bond news, not in all-time high record, but just a recent record levels of bond news, mainly because the payroll numbers was higher. So what it means that people expect that the US economy is stronger, and then the Fed is likely to delay cutting interest rates. I think some have even talked about only October you see some rate cuts. But do note some of the pushback we have is that do note that the payrolls have always been overestimated. So if you recall in August, they mentioned that the same provider that giving you all these monthly numbers mentioned that payrolls were overestimated by 818,000. The final revision is going to happen, probably going to be lower by 1 million jobs. So why the difference? Because what we get every month is an estimate sample, and then every quarter they'll get the final number based on tax records. So that's the actual number. So the estimates, they will also estimate how many small firms are started and so forth. The reason why we are not too worried of the rise in bond yields is also because there's a Trump factor. I mean, so anything can happen. Obviously, is a walking tail risk. So he can actually announce a trade war, and if that really happens, then the bonds will be the haven trade, the safe haven trade, because everyone will look to de-risk. That could happen on January, the 20th of January. He could also pull financial support for Ukraine, and the bond market will also view it as positive because the US doesn't need to go and fund the Ukraine so much. So there's the Trump factor that could actually swing bond yields lower. The third reason is also the reason why bond yields also climbing is also like Glenn mentioned, the term premium. So usually, if you buy a bond, the longer term bond should be higher, otherwise because there's so much more risk. But the last few months, almost the last 12 months, it's always been inverted. That means, you buy a 10-year bond, the yield is actually lower than the 2-year, or it's like a fixed deposit. 10-year fixed deposit is lower than the 2-year, which is unusual because it usually should be higher. But right now, it's just normalizing. It's now 44 basis points above the Fed funds. Longer term is above 90. Longer term is about 90. So unless the bond yield start to climb 90, 100, 200, then you're a bit more worrying that there's some bond riot or bond issue coming up. Until then, we think this is a normalization of just the bond yields. And like what Glenn mentioned, actually the steepening curve, that means that like your longer term bond fixed deposits are higher, is actually good for banks, because banks normally take your fixed deposits or your current account. Normally, at most, they take a 1-year fixed deposit, and if they take this 1 year and then they park it into bonds 10 years, they normally get much. They should get higher yields, but the last 1-2 years they didn't. So this time around it will be better, and that's one of the reasons why DBS mentioned that even though interest rates came down, they can hold their net interest margins, because they took I think 4 or 5 billion, if I'm not mistaken. I don't have the exact number, but they took it and they parked it in a lot of the US bond yields are the longer dated. In terms of the impact to equity for higher bond yields, on paper is definitely negative, but there's no real magic yield number to watch. I mean, I'm not sure, maybe 5%, 6%, then in the market will start to, but when your yields start to climb higher, then the valuations will start to matter. And then of course the one that hitting even higher, the bond yields, is actually UK yields. So it's about 16-year high. I think you take the 30-year bond yield is almost like I think it's like 1998 highs. But anyway, so the risk of this is that negative spiral, the least trust moments. So what you worry is how the government reacts. So if the government, they don't seem to, but if the government were to worry that bond yields continue to rise, what they might do is they will try to cut back on their government spending to try and appease the bond markets and make the bond markets happy. But of course, this would actually make the economy slow down, and then as a result, you get this vicious cycle. You cut, and then the bond yields climb even more because they see your growth coming down. So we don't see that yet, but of course this is what happened. The so-called least trust moment, and the former prime minister got kicked out because the bond yields keep on spiking up. And of course, 2013 we have the whole EU bond yield surging, but so far we don't see that. It seems to be more a normalization of the term premium. But we still like Elite REIT, even though the rise, because we still may have a buy call. Elite is paying about 10% dividend yield. And even though bond yields have risen, it doesn't really impact their interest expense, because their loans are actually pegged to short-term rates. So their bonds are pegged to the they call it SONIA, but basically it's the sterling overnight interest rates, and that has come down because the Bank of England has been cutting rates. And the other thing that what they have done well for Elite is that the share price was weak because their major tenant, which is the government, actually gave back 10 properties, but they've actually successfully resold some of these properties at higher premiums, and also repurposed some of these properties to either student dorms, or even one of them is actually to data centers. I'll just move on to some of the events to watch. So this week will be a lot of news. The big one will be in green, which is the US CPI. So the core CPI is expected at 3.3. If we get any number that's very high, then of course the bond yields are going to go up even higher. But there are going to be lots of bank results coming up, so JP Morgan, Citi, and so forth. And then TSMC, and then there will also be the Chinese GDP. The following week, you have a OUE read for webinar. It's open to anyone. Next slide. Okay, this is just to show you the construction contracts. I think we did do it in our presentation strategy, but the blue line is the contracts awarded the last 12 months. So you can see that it's back to the high of 45 billion rolling 12 months. And this is a record number for Singapore. And the red line is when you actually do the work. So building material companies like Pan United or even BRC, you won't see the revenue yet. but the revenue of the revenue is like this red line, excuse me, and it will just follow the blue line eventually. It will just climb, surge to new record levels. So construction industry is still very vibrant. Exports here, just to show the export trend, it's just generally in line. I mean, it's not like extra very strong, but at least it's just trending in a positive territory rather than 2023 when there was a lot of destocking and hurt a lot of electronic companies. Next slide. This is just a snapshot of the jobs data. I mean, nothing much here because it's a bit hard to see. It's generally stable. I wouldn't say it's very robust. Maybe there's a perk up in December, but it's partly seasonal because seasonally, December is really a stronger month. Next slide. The table here on the left, you can see all the surging bond yields, but of course you notice Singapore, more important for us is Singapore bond yields hasn't really climbed to, I think it's now 2.8, 2.9. It's generally quite stable. It's only the US and UK where you see this spike up. If you look at the chart on the left. Germany also generally stable. Of course, Japan is expected to climb and they're expected to raise interest rates or at least narrow their yield curve control, so-called. The one on the left is the blue line is the bond yield curve. It's similar to what you see on the left, the US bond yields. But the red line is basically the difference. So in the past, the bond yield, the premium was negative, which means that, again, if you don't think of bond yields, just think of it like fixed deposits. Like, how can I get a lower return if I put my money longer, right? So it's negative, but only recently it's starting to normalize. And it's just climbing back to normal levels. The long term is about 1 percentage points. So I don't see a major disorder, but of course, it is causing a lot of worries in the marketplace because the Fed cut rates. So you call this the bear steepener. I mean, if you want to go and be more technical about it. Okay, I think you can move on to Q&A. Thanks.
Yeah, I'll start the ball rolling then for Q&A. There's this question, I'm not sure whether it's a typo. I don't really understand. Target prices of LG. Yeah, this one maybe you can just retype your question again. Sorry, let me see. Yeah, I think it's asking why is the banks down today despite US Treasury yield going up on Friday. I think it's a little bit of profit taking, but the banks have been the Singapore banks, right? This is more on Singapore banks. It has been on this quite a historic rise, I would say, at least for share price. So maybe it's just a bit of profit taking before their results, which will come out next month. So I don't think it's it's much of a concern. Even it didn't dip slightly, so it's not like a big impact. But overall, we do think that like what Paul has mentioned, what I have mentioned, is that overall in terms of the 10-year, the long-term yield increasing is only going to be beneficial for the banks, especially more so for Singapore banks, because they do have so much of these excess deposits. They're able to put it back in longer term, and now if the interest rates are higher, right, they'll be able to contain and maintain or even improve their net interest margins better. Previously, when it was still slightly inverted, it was still inverted, the yield curve, right? They still managed to maintain their net interest margins, right? So now when it's back to normalization and it's steepening, I think it's just going to benefit them even more. But we won't really see, there'll be a bit of a lag, so we won't see this come into effect for the fourth quarter. I think we'll only really see it in the first quarter's results. Yeah, that the effect of this sort of normalization of the yield curve. One more thing, I think it's about two more. So one about the expectations of the US bank earnings coming out this week. Yeah, so if you look at my slides previously, several things that we'll be watching out for. The first thing, expectations for the non-interest income to still be strong. I think that will really be the main talk. So if you're looking at banks that really are concentrating on like investment banking, you look at Goldman Sachs, Morgan Stanley. I think these two banks will do quite well, continue to do quite well. They did post record profits, and beat expectations by quite a bit, right, in the third quarter results. So in fourth quarter, I don't think that will change much. I think one thing to worry about would be how well they're able to maintain their net interest income, net interest margins. We've finally seen, as I shared earlier, that loan yields have finally outpaced cost of funds. So I don't, we could probably see, finally see this stop in the decline in net interest income for the banks. I think one of the worry, or at least something that could be a worry, would be the credit card debt and credit card debt and credit card charge-offs. So while it has been the main contributor to loans growth, right, for the last few quarters, it is also contributing to their provisions and allowances, right? Because as the loans grow, it will also grow. So that's one of the worries that that we have to watch out. See, if it's growing much faster than loans growth, then that's something to worry about. But if it's still in line with how fast the loans, how much they are contributing, then their allowances and provisions also increase. So that is sort of in line with the expectations. But if it does surpass that growth, then that is something that means they might be just over lending or not really watching who they are lending to, the consumers that they're lending to. But overall, I think earnings wise, it should be rather flat, I think, because it will be offset by the flattish net interest income, but non-interest income will sort of offset that. Then again, higher provisions will also then again offset also this higher non-interest income. So I think if you look at it year on year for fourth quarter, it could be I think a rather flat year for a flat quarter of earnings for the banks, for the US banks at least. I think I saw one more here on the OCBC and is OCBC sorry, I'm trying to read this question. Is OCBC a better buy than UOB? I don't think it's we both of them are in our stock picks, so they are in our the Phillip 10. So absolute 10 model. I would say both are different. It depends what you are really looking for. UOB is concentrating really on the non-interest income growth as well as growth into other geographies. So they have mentioned that their city acquisitions have accelerated their growth into the ASEAN region by 3 to 5 years. And they have also shown that why we are seeing that fee income has continued to grow, and also their presence in these ASEAN 4, which they call, I think, Thailand, Malaysia, Indonesia, and Vietnam. So this has grown quite tremendously, and this will be what is going to push them to the next level, where they are not just an SME, a Singaporean SME bank, right? They are now looking at wealth management, many other lines of income, not just lending to SMEs. Right, so that's one way to look at UOB. And also, what was previously mentioned in the last quarter was that the management have mentioned that they're going to do share buybacks. UOB has not really done drastic share buybacks, so they're saying that that's the way they're going to, in their words, aggressively manage capital or give back capital. Right, so that's one of the things. Also, their excess capital has increased quite a lot due to the new Basel IV requirements as compared to the other banks. I mean, like in relation to the other banks, the CET1 has increased quite a bit because most of their loan portfolio is in the SME sector. Hence why their CET1 has increased. So now they have a huge buffer where they are willing to give back more to investors. So that's one way to look at UOB. For OCBC wise, you're really just buying the upside in their dividends. They still, even though UOB's CET1 has increased so much, LCBC CET1 is still the highest amongst the 3 local banks. So that's really just, it just speaks for itself that they have been hoarding this excess capital for so long that now they have quite a large amount. It's around 4 billion Sing dollars. 4 billion Sing dollars is equivalent to how much they did pay out. I think it's slightly more than what they paid out in 2023. Right, so it shows that they can effectively increase their dividends by 100% and yet still meet their optimal capital ratios, right? So that's what we are one of the main upside surprises for when it comes to OCBC, where there is an upside surprise to the higher dividends and possibly share buybacks. But then again, they haven't mentioned anything, but they did not say no to anything as well. So yeah, take it with a pinch of salt with what they're saying, basically. I think okay, asking about how the California fires impact US banks. I don't think do they have a significant insurance segment? No, the insurance segment, even if there is, it will be quite a small segment. So If anything, I think the insurance companies, but they also have buffers set aside for this. I can't really speak. I don't think this will impact the US banks, the California fires. Yeah. I think that is all for me. Yeah. Let me hand it back to the rest of my colleagues. Thanks.
Yeah, Darren, you want to go ahead?
Yeah. Thanks, Glenn. Thanks. Yeah. Let me talk about MLT. Yeah. So there's a comment. Please comment on MLT. Yeah. So for MLT, over the past few quarters, we saw their portfolio is relatively resilient because they are very geographically diversified. So most countries are generating positive positive single digit rent reversion. But for Singapore, it's been generating low double digit in the teens. So for Singapore, we're expecting the rental reversions there to slow to the single digits rental reversion growth from the post-COVID e-commerce boom. And so 20% of the portfolio is in China. So China is the weakest segment for them or weakest geography for them. So they've been experiencing negative double-digit rental reversions for China for the past I think almost 2 years now. So the most recent quarter was down 12% negative rent reversion for China. So going forward, it might be possible that the Chinese negative rent reversion has almost bottomed. So we'll expect kind of similar low teens double digit rent reversion for China for at least a couple of quarters more. And after that, it might slowly start to improve to lower single digit negative rent reversion for China. Yeah, so that's the weak point for MLT. Basically it's a China portfolio and a little bit of slowing rents in Singapore as well. Yeah, so Singapore accounts for about 20%, China accounts for about 20% as well. Yeah, so those are our comments. Oh yeah, and MLT will be releasing their third quarter results next week. Yeah, so we'll attend and we'll have more latest updates from there. Yeah, so that's for MLT. There's another one. If interest rates is expected to remain higher for longer, how will it impact the real estate developers and property agencies' share price? Would it cause the demand for new condo sales to slow down? Yeah, so post the interest rate cuts last year, we saw that the demand, especially in the fourth quarter, really shot up for the new home sales, the take-up rate. Yeah, so going forward, we expect this year there are about 14,000, and we think the demand with lower interest rates, definitely the demand might be slower and not as high. Yeah, but in the longer term, we still think that it might be possible that the demand will come back gradually over time, but it won't be so fast as interest rates are still quite high for now. Yeah. I think I'll leave that question there in case Paul has anything else to add for this on developers and property agencies. Uh, Let me see. There's a question on Prime US REIT. Can't remember what it was. Let me find. Oh, will Prime US REIT have property valuation soon? Yeah, so Prime US REIT, they've already done their portfolio valuation, but they've not basically reported their valuations yet. So not sure whether they'll report it before the FY24, but definitely by FY24 results, it'll be out. So like I mentioned during the presentation, the recovery between among all the different sub markets in US is very different. So for Prime US REIT, their properties are better located than Manulife US REIT. And for Manulife US REIT, for instance, we saw some of the better located assets. They, in fact, did not experience any portfolio devaluations. In like for Phillips, they experienced about 2.2% portfolio valuation gain. So for Prime US REIT, we do not expect similar levels of portfolio valuations decline for them. And we think that their gearing will remain under 50% by this post portfolio revaluation exercise in FY24. So right now it's about 47%. Yeah, we think it is likely that they'll remain under 50% for their gearing. Yeah, so if they do have any updates, I'll definitely update. does it still make sense to lower down the Singapore REITs in view that the number of interest rates likely to be lower and versus before? Yeah, so despite the fact that the interest rates likely to be lower, like fewer cuts, the most REITs will still, at least half of them in our view, will still experience interest or rather DPU increments or improvement year on year. So that's mainly from the fact that a lot of the REITs, their fixed portion, they've already um, reset those rates to a higher rate, as well as the fact that um, a lot of them have started to gradually have lower interest rate hedges. So previously it was 80 to 90%, but now you see a lot of REITs like having lower fixed percentage of loans that are on fixed rate. So they'll start to benefit from the lower interest rates. Like because last year the Fed already cut 100 basis points. So yeah, the REITs will start to benefit from those as well gradually. Yeah, so those are so and coupled with the fact that now valuation wise price to NAV they're still trading almost 2 times standard deviations below the mean and trading even below COVID-19 lows. So we think those basically valuation wise it does look cheap for REITs. And for subsector preferences, we prefer the retail sector the most because we believe that there is a strong potential for interest for rental reversions to continue to be high. Like for the suburban malls, we think it's possible that they can get high single digits. So that is continuing from 2024's now positive rent reversions. And for the downtown malls, the outlook is still very strong from the tenants' perspective. So they believe that with increasing population and improving international visitor arrivals to Singapore, it's expected to reach pre-COVID levels by this year. So all this will help to definitely boost tenant sales, and the retailers are confident in paying higher rents. Yeah, despite we see in the past, like over the past year, the retail sales wasn't that strong, but basically their outlook, they think it is they're optimistic. Yeah, because the outlook versus retail sales more of a backward looking. Yeah, but when they negotiate for rents, they are looking more forward. So they believe forward it's bright. So yeah, we are favorable on the retail subsector. Yeah, and in our REIT monthly, we have a tabulation of all the REITs we cover, the target prices and our DPU forecast. Yeah, so can yeah, you can take a look at that for our stock picks. Uh, yeah, that's all from me. I hand over to my colleagues. Thanks.
Hi, thanks, Darren. I'll take on some questions. First question I see is what's your expectations of TSMC results this week? Yeah. Last week TSMC actually came out and reviewed their revenue results. So based on the revenue results itself, it is in line with their guidance, which is for that quarter itself is 26.3 billion, and they guided between 26.1 and 26.9 billion. So it's around like the halfway range. So I do think that the results for TSMC will be quite positive, and because the guidance itself is already positive, and it'll just be within expectations. Yeah. Okay, next question is on hi, what's the impact of Centurion REIT news? Yeah. For context, Centurion recently came out and said they are in the midst of exploring listing of a REIT itself. For when I called Centurion itself and asked them about this announcement, they said they are in a very early phase of this exploration stage. So they can't really give me any numbers or like what kind of fees will be incurred or so on and so forth. So however, we do think that if they actually is able to pull off this REIT, we do think that they are able to unlock value from the worker dormitory side, because a large portion of their revenue come from worker dormitory in Singapore. However, because supply is already almost reaching demand for worker dormitory in Singapore, we do think that in order to unlock more value from this kind of worker dormitory, a listing of REITs will be very good for Centurion itself, because they are able to finance the REIT with the worker dormitory rental rates and just unlock more capital from the REIT itself. Yeah. So in 2015 itself, they did try to list a REIT. However, they put back because their portfolio was not diversified enough. However, today it is slightly more diversified with more student accommodation in their portfolio. So there may be a higher chance of them successfully listing this REIT. Yeah. Next question. Any good updates for AMD at the CES? Yeah. AMD did announce some product announcements. For example, their PC CPUs, the Ryzen 990 series to compete with Intel's CPU. And they also gave a snapshot of their Radeon 9070 GPUs. However, they didn't really give a lot of information. For example, the price of the Radeon GPUs. So I think a lot of people were very disappointed with that. Like why they are unable to give more details about this kind of GPU products. And many people are speculating that, because Nvidia came out with such a strong product lineup, AMD is unable to compete with Nvidia directly. So they would rather not risk exposing so much information for these Radeon GPUs. Yeah. So I guess we do have to keep a lookout for the AMD products launch in the following year. However, we do think that um the strong driver for AMD will still be the EPYC CPU processors for data centers, and as well as the MI300X GPUs, which we do feel that they will still take in a good amount of revenue and profits for AMD in the coming year, as hyperscalers are ramping up their capex. Yep. There's one more question on okay, there's one question. Hi Paul, despite the robust construction sector as mentioned, how come Penn United only got stagnant for a very long time? Any baggage that is holding it down? Even Hong Leong Asia is doing better. Yeah. For news wise, we don't see any adverse news that is holding down Penn United. My personal opinion is that Penn United only release results every half yearly. So from the analyst point of view, when the results are released, then we will revise our target price and we'll give our revisions for our outlook and so on and so forth. So I feel that the thing that is holding down Penn United's growth in share price is because there's just not much news flow for Penn United, and however, upcoming in February they will release their results. So I think that's a catalyst for Penn United itself. And in first half of this year itself, Terminal 5 will start constructing. So we do think that there is also a very strong stock catalyst for Penn United, because they will be able to take in revenue from the construction of Terminal 5 itself. Yeah.
By the way, Penn United share price is up 45 to 46% last year. So it's not like it didn't go, just that the last few months.
That's true. Yeah.
If you add in the dividend, you probably got a 50% return from Penn United last year.
Oh yeah.
And
yeah.
you want to mention about Hong Leong Asia, your a bit of the worry on the PPVC. Yeah. Thanks.
Hong Leong Asia, we don't cover Hong Leong Asia currently. But what we do know Hong Leong Asia is that they do have a prefab. They are involved in the prefabrication of HDB units. I mean, they have a prefabrication manufacturing plant which produces the BTO units for HDB itself. So I think it is also a driver for Hong Leong Asia, because as the amount of HDB BTO projects comes up, it is also a driver for Hong Leong Asia stock. Yeah. I think that's all the questions for me now. I'll hand over the time to my colleagues. Thanks.
Yeah, but just to add, just to add on to what Iqbal said, I think we're a bit worried on the PPVC. I think the feedback we're getting is that HDB is not doing a lot of PPVC. So, and Hong Leong Asia has the China business, so that's something to be wary. Yeah, not very. I mean, we're just a bit more cautious in terms of that. Yeah, can you invite Pan United for we did it last December, so maybe when the results is out, we will thanks Anson, we will do another round. But they did one with us, I think, right, Yipman, I think in on November or December.
Yeah, I think they did recently,
Yeah,
2 months
yeah.
ago.
Yeah, so they did one with us. Let me run as much as I can, then I hand it over to the rest. In the SG market outlook 1 week ago, Phillip is expecting 4 rate cuts in 2025. With the latest employment data last Friday, is the forecast still valid? Any revision? Yeah, there's no change in our forecast. You know, one thing to note that if you follow what happened last year, the expectations of interest rate cut can swing every month. You will just swing. I mean, like every quarter it can be up. Can be 4 cuts, then no cuts, then 2 cuts, then 3 cuts. So we're still holding it. The data points we are looking forward to is maybe that we think inflation numbers are going to continue to trend downwards, especially from January onwards. Maybe this coming December might still be a bit hot, but from January onwards, we think it will trend downwards. And that would give the Fed room to cut. And we think by February, there was also these big revisions. We think that could maybe cause a lot of cautiousness by investors in terms of taking on all these payroll numbers. And this is what our expectations on why we think there should be formal rate cuts. The other question is, what are your views on fixed income investments, please? Namely bonds. With you go up, high up, how do investors position? Yeah. So bond yields, Singapore is still around 3 years, but for US, if I'm a financial planner, if let's say the bond yields in the US Treasuries cross to 5%, it is a very compelling buy, especially from a Singapore perspective. So if you look at Singapore market, sadly, the last 17 years, if you look at the dividend yield, we're probably getting like a 5% return per year for the whole Singapore market the last 17 years. But if the US bond yields, of course, there's currency risk, but if the US bond yields can give 5%, then you're virtually taking equity-like returns with zero risk, because this is essentially treasuries. So if bond yields cross 5%, it makes it a very compelling story. I mean, if you're a financial planner, I guess, if you have clients, right, because you might have to park some money. Since I mean, the equity market, I'm talking from Singapore perspective. Of course, the US market, the last few years is the annualized returns about 10%. So that might be a bit harder to push back. But if you look just numbers wise, Singapore never crossed a 5%. And if the bonds can give you 5%, then why not? It's zero risk and my returns are like an equity. So that's my view. I think there could be more room to climb for bonds. Again, this is like 90% guess. But you really have to cross the 20th January thing. I'm not sure what Trump might say. He might actually do more rate cuts, and that might spook the bond markets. So that is one thing that could happen. There's this trading on SDR. I think I leave it to Zain. What is the target price and outlook for Vilma with the divestment of? Okay, we don't have a target price for Vilma. It's not. We can give you a TA one, but the acquisition is negative. I think they are acquiring another 30% of Vilma from the partner, from Adani, from their Adani partner, and Adani is trading like, I don't know, 30 over times, 35, 36 times PE. Vilma only 9 times. Yeah, so I wouldn't say this is like a bailing out of the partner, but I think it's not on paper. It doesn't make financial sense in the very near term, because all the Adani companies, they're all like, it's better to sell rather to buy. They're trading at 35 to 40 times, and when in briefings with Wilmar, they always wanted to sell their stake because Adani Wilmar, they need to hit the 25% free float. I think now it's only 12%. So I was a bit surprised they actually they bought it. I don't know what's behind the scenes, but it's not a good buy. I mean, it's so expensive. It's still going to drag down earnings. Hi Paul, good news is bad news now. Will we see good news being interpreted as good news? I think the one to watch is just, I mean, without the obvious, is really the it's really the corporate results. So I think if the bank results, which I think should be good, then that could calm the markets. That even though we have a so-called inflation, but it's at the expense that we actually, on the flip side, you're having good corporate results. So, but this is purely sentiment. This can swing as I speak. This thing can swing day by day. But I think if the corporate results will be key this time around. I mean, this is the obvious thing. Yeah. Is a high yield of 10-year bonds an indication of future US economy continue to grow? What about the impact of US debts? It's a combination. I think it is more of inflation expectations and Trump, because if you look at the tips, so tips is the inflation-linked treasury, inflation-linked bonds. So that is actually also rising very sharply. So it's more of investors' view of Trump, because when Trump comes in, he said he's going to do cuts, and he also wanted to remove the debt ceiling. So that as a bond investor, it's a bit more alarming. And the third thing is, because of the deficit, you're talking about every year they are issuing 2 trillion of extra bonds. So there's a lot of bond supply too. So it's a combination. Very hard to isolate what is the one factor that's causing bond yields to rise. Okay, this one I know obviously is just a joke, but hi Paul, do you think US can take control of Greenland and Panama Canal? I think we all saw the news. Of course, he said it's economic force, not military force. So far in his first presidency, he's been very hesitant to use military force. So it's more, I guess, more economic force. Why are China, Hong Kong markets starting off poorly this year? I think there hasn't been any robust data from China, and of course you have the 20th January event. But so far, if you notice, Trump hasn't really attacked China. I think he's hardly attacked China. He's been attacking. Don't ask me why. Attacking Canada, attacking Mexico, attacking Denmark. Yeah. So he's been attacking all these, even attacking Israel recently. If you saw the news, also attacking the Israel Netanyahu. So he's attacking all his allies. So and he's actually hasn't even said, and he's actually wants to meet Russia. So it's like this is really it's like the rule of the jungle. It's the strongest. So he's warming up to the stronger ones, and then just taking out the weaker ones. I'm not sure. But this is good news. I think in 20th January, he doesn't mention much about China and starts putting on tariffs on the others. So it could kind of de-risk the Chinese market a bit. Yeah. How many cuts do you see this year after last year? We are still sticking to it because these things are very volatile. If you do, like I mentioned, 1 year ago, market was thinking no cuts. First quarter of last year, no cuts. Then they started to shift to 2 cuts, then suddenly shift to 4 cuts, now shift back to no cuts. So again, just take it with a pinch of salt of the expectations for rates. But having said that, I know if you're a REIT investor, do note that even without cuts or even 1 or 2 cuts, interest expenses for most of the REITs have already peaked. Because the cuts were done in 2022, we are already hitching almost the 3rd year. So most of them have already refinanced. This is probably the last year most will refinance the cheap debt that they had. That means they refinance to the higher rates. So most of it has been already completed. I'll take this last one before I hand over to the rest. I missed your recent Corporate Insights presentation with Alltech last Friday. Can I have the link? Yeah, okay. So for Corporate Insights, we don't really do a recording because most of them don't. I think the one takeaway that I can say, I mean, since he publicly talked about it, was that he was because the forecast that the market's coming out for this year's earnings, 25 million was mine. The highest is 28 million. I think he didn't say he's comfortable, but he said he's cautiously optimistic, which basically probably is a quote word to say he's good chance to meet those forecasts. So the rest were more like educating investors what was happening. So I think that's the big takeaway that I got from the event, that he seems, I'm not sure, but he seems confident that he can hit those numbers. I think last year was 19 million. So this year, if the forecast could be 25 to 28 million. So the growth number is intact. Okay, I hand up over to the rest in case the rest like Suntec or even some of the ETF questions.
Thanks, Paul. I'll take the SaaS question. Please comment on the business outlook and the share price for the next 12 months. Yeah, so we have a target price of $4.6, and we still believe FY25 will be an exceptional year for SaaS, and profit will mainly be driven by the cargo handling side. And cargo momentum is very likely to be sustained before the implementation of US tariff. And currently, we are still seeing a surge in cargo volume from the advanced inventory booking orders. And even with the upcoming tariff, We believe SETS is able to capitalize on the expanded market share after acquisition of WFS. And then US is only accounting for around 30% of the cargo handling side revenue. And yeah, we like SETS also because of its strong pricing power. And we believe there's going to be more opportunity for SETS to repress their customer this year. Yeah, so generally the outlook is still optimistic for SETS. And for Suntech rate, is it a buy at the current price? What is the chance of being taken private? Yeah, Suntech, we have a target price of $1.41, and currently it's pretty unlikely for them to be privatized. And the company gave a revised offer of $1.19, which is around 40% discount to the net asset value. And we think the offer is purely to comply with the code of merger and acquisition in Singapore. Since they requires the offerer to match or exceed the price paid in the open market for the share it acquired during the offering period. Yeah, so Golden probably just offered to comply with the code. Yeah, so less likely they'll be privatized in the short term. Yeah, that's all for me. I'll hand over to Zing for technical pause. Thank you.
Thanks, Mel. Move on to the technicals. Let me just share my screen. Yeah, let me see. Okay, the first question is Manulife US REIT. Yeah, so for Manulife US REIT, I think overall we're still seeing a bit of weakness currently since the breakdown of this range consolidation over here. This is 9.5 cents from support then to resistance, then it's just doing another range over here, another test of this lower range support around 8.8 cents. So I think if this level were to be breached, I think we could see some further weakness ahead towards the next support, which is close to about 8.2 cents. Yeah, that's for Manulife US REIT. Then for Comfort Delgro, I think is just mostly just doing consolidation sideways. The main range is from like 142 to 150. So I think it's just hovering sideways for now. And for Java, I think overall uptrend is still quite a strong uptrend counter over here. I think for now we just likely to see some sideways consolidation. A retest of the resistance at 47.5 cents last week, and just a bit of a slight pullback. I do expect this 44.5 cents range support to actually hold for the timing. So just maybe some consolidation for now. Okay, then next question is on CLI. Okay, for CLI, I think there's been quite a bit of a pullback since the start of this year. What is currently trading at this downtrend channel support is about 245, 246. Then previously there was also this swing low support around 242 back in August last year. So I do think over here at these levels, we could see maybe some bounce to happen. But I expect overall the trend is still quite weak, so I do expect some resistance above 255 onwards, which was the recent breakdown level. Yeah, when there was this there's a few days of selling with increased volume as well for CLI. Then for MPAC, which is Mapletree Pension Commercial Trust, I think nothing too much for now, just trading sideways, but still holding resistance around 125. So support is around 119. Yeah, so just trading sideways, I think, for the time being. And below 119, there's a few support levels below, which is about 117 and about 114 next. The next one is Bank of China. So for Bank of China, I think it's relatively quite strong as compared to some of the other counters. For Bank of China, I think just doing a bit of range consolidation, still quite a lot of resistance above 380. But you can see that the support is actually going upwards. So previously it was this 348. Then this resistance at around 365 turned into a support. So I think overall for now, probably in a bit of a consolidation between 365 to about 382, 383 there. But as long as this support at 365 still holding the price, I think it could still move higher. The highs are likely to find resistance from this trend line over here. And so maybe perhaps the next resistance upwards may be closer to 390 if it does make a higher high. Then next question is on SRT. So for SRT is the CSOC IHS REIT ETF. So for this, for this, I think for now it's just a bit of a range consolidation. Still a lot. The key resistance to watch here is still 75 cents. Needs to break upwards and go above it for a reversal, but this has not happened. So I think just a bit of pullback from resistance last week. So I think for now, likely 72 cents will still likely to hold as support, I guess. Over here, still maintaining a bit of a range for the time being. Then next question is on Mapletree Industrial Trust. For Mapletree Industrial Trust, I think still generally trading along this downwards resistance line. Last week, pullback from this confirmed resistance at 226. So I do expect a bit of a slight further pullback, possibly to retest this single support closer to about 218. Overall, since it's just in a downtrend since September last year. For HST is Lion OCBC Hang Seng Tech. So for this, I think it's been holding in the range since October last year. The main area is about 71 cents to about 80 cents. So today, another retest of this support level. I think we could see a bounce. But overall, I think there's still some weakness in the near term with the recent breakdown at 73 cents to 74 cents area over here. So I'm still expecting some resistance to come in over here. Then should this 71 cents not hold as support, I think the next support level to look out for is maybe closer to 68 cents over here, where there's a gap, still a bit of a gap over here during the run up like in September last year, as well as the prior swing high resistance in May last year as well. Okay, then next one is on venture. So for venture, I think overall still continuing on the downtrend since August over here. But for now it's a bit of a range consolidation. Resistance at $13.20, then support is about $12.60. So I think here it could just continue to be a range bound for the time being. The next one, hi Thomas, what's the team's take on EXE? I think we don't have coverage on it, but I can do a TA. So EXE, it's Expand Energy Corporation. So for this, I think overall trading in this upwards channel over here recently, there's a breakout of this resistance around $100. So I think, yeah, we are likely to see the continuation of this uptrend going on over here since there's a breakout consolidation from 95 to 100 recently. Okay, then I'll go through some of the Hong Kong counters. There's quite a bit of questions. So first up is 700 10-cent holdings. So looking at 10 cents chart, gap down last Tuesday below the support of 395. Currently, I think it's just doing a bit of sideways. I think this support region at about 350 is about 350 to 360 over here should still hold the price. So I think I will just expect a bit of a sideways consolidation with resistance above 380 for the time being. Then next question is on Alibaba 9988. So for Alibaba, I think there looks like a breakdown of this support of about $80 recent just today. So I think we could possibly expect a further weakness to continue its pullback. So I think the next key level to watch that could act as support is probably closer to about $75. 75, then maybe like 17 minutes. The next one is on Baidu, which is 988. For Baidu, I think overall still quite weak as well, just retesting the levels seen in 2022 and over here November last year. So this support level is about 75, about there. Yeah, we could still see a bounce to take place, but I think overall, I would expect a lower high at about 78, 79 area. So yeah, overall still, the momentum still looks quite weak for Baidu. Yeah, possible to reach, to have a lower low as well. And then next counter is JD, which is 9618. For JD also a bit of a weakness for now. Just retesting this swing low support at 129, but I would expect some resistance to come in above 132 and above. So I think we could still see a continuation downwards if it fails to hold at support. So next support level to look at maybe be at 120, I think, for JD. And next one is 2318, Ping An Insurance. For Ping An Insurance, I think on Friday there was a breakdown below this level at around 42.70. So I think we'll still see some further downside, maybe towards this 38.70 level over here. Yeah, it's a next support level. And next one is 2331, which is leaning. Yeah, for leaning, I think there's also a breakdown of this range consolidation between like $15 to about $18.30. So I think we could still see some further downside. Next support will maybe come around closer to about 1380. Then next one, which was a previous horizontal level in the past, was around 1255. Next is 3191, which is this Global X China Semicon ETF. So for this ETF, also just in a bit of range consolidation after a breakdown recently at the start of the year below this 39.70 area. So I expect this to be a resistance, also resistance that come from this downwards resistance line. That's about $41 over there. So about 40 to 41 area will be resistance. Support currently at 37.50. I think I'll expect a bit of a range consolidation for the time being with near-term resistance just right on top. Yeah. And next one is on 2801, which is this iShares MSCI China ETF. Yeah, so for this, I think there's a breakdown below this $19.80 level. So a bit continuation on of the bearish momentum. I think we could still see price trade toward this trendline support over here. Let me just highlight it in blue. Yeah, that's closer. That may bring price closer to about 1850 over time, where this was the previous horizontal resistance as well. So maybe over here, then there could be some better support for price to do a bit of rebound. Last one, I think is 2806. 2806 is the Global X China Consumer Brand ETF. So for this also, there was a range consolidation that took place in October, but it's a breakdown of the key support around $42. So with that, I think we could still see some possible downside. The next key support level, I think, will be around $39, $39.50, about there. Yeah, that could be the next support. And maybe I just go through the chart, the Hang Seng Index as well, since there's so many questions on the HK counters. So for Hang Seng, I think today still continuing on the weakness for last week with the breakdown of this support level around 19K. So 19,000, below 19,000, I would think the next key support that might have a rebound maybe closer to about 18,200, which was this like inverse head and shoulders neckline resistance in September last year before the rally. Then over here, generally is in this descending wedge over here as well, in blue. I think over here there might be some confluence of support. Yeah, for now, since they could hold the price after this pullback recently. Okay. And I'll move back to some of the Singapore counters. So next one is Keppel Corp. Okay, for Keppel Corp, I think some yeah, just a bit of a pullback from resistance around $7. Some slight weakness, but I do expect price to hold around this 670 level, this swing low. So I just expect some range consolidation with short-term resistance at 690. Next one is on Seagram. Also a bit of a pullback. I think it's okay. Still overall quite strong. I think as there was a big rally. I think over here, then it's just doing a pullback. This previous resistance around 213 to 215 should hold as a bit of support in the near term. So it's just a pullback on lower volume as well after the rally over here. So I think could be doing a retest of prior resistance that should find support. Okay, next question is AEM. So for AEM also doing a pullback after a strong rally. I think quite similar to Seagram over here. I will expect the next support level will probably be around 155 over here. 155 previously, it was a level over here, and this breakout of resistance. And current resistance, I will expect 163 from the breakdown here. So maybe a bit of a consolidation in the very near term for now for AEM. For Frank, I think, yeah, I had a technical sell call on Franklin, so I think I would still expect some weakness for now, since above 116 to 119, this area is a current resistance. So perhaps I think I will expect price to at least near to test this 108 support level again, given the recent weakness. Then for Singtel, I think Singtel has been quite sideways, just moving sideways. Overall, the main range to look out for is this $3 to about 370 in that area. So I think as long as price hasn't got out of this range, I think I will still expect some sideways to take place over here. Yeah, I can see the volume has also shrank quite a lot since the last week of 2024. And so just some sideways consolidation, I think, for now. Okay, the next one is on Semco Industries. So for Semco, I think still just pulling back from the resistance around above 565. I think it tested on Thursday. A bit of pullback. I would expect support to come in at a region of about 535, this level over here, which was this swing low, and then also this upward support line over here. So then maybe do a bit of a sideways consolidation with resistance above like 585 afterwards. And next question is on sets. Yeah, for sets, I think overall it's a bit of a consolidation for now. The key support is still holding at 355, which was this. We can see it tested multiple times in the past since September last year. So just in a bit of range with resistance currently around 360, above 360. We have this downwards resistance line as well. So yeah, just a bit of a consolidation. Then if this support fails at 355, then we could expect some lower levels. Yeah, so that's for sets. I think I'll take just two more since it's close to one. For WeHer, next question on WeHer. I think WeHer currently they are just experiencing resistance at this 46.5 cents to 48 cents area, which was this breakdown area, this support level breakdown in mid of December last year. So over here, seeing resistance, but short term, 43.5 cents to 44 cents, this area should act as a support with this breakout of the range over here. And so I just expect some range consolidation between this 43 to 46 cents in the short term. And HST, I covered here. Let me just see. Next one is CICT. For CICT, I think for now just still holding the range between like 190 to 199 about there. So I think still nothing much has changed. Yeah, I think that will still continue for now. And let's take one last one on better than Ascendas REIT. So for Ascendas REIT, I think just also range consolidation as well, just pulling back from resistance at 265 days swing high recently. The support will come, I think will come around from this area, around 250 to 255. So I think you'll probably just stick to this range trading for the time being. I think that's all for the TA from me. I'll pass back the time for my colleagues if there's anything to add on. Thanks.
Yeah, thanks so much, Zain. I know there's still one or two more questions. Let me just very quickly mention any view on CSE Global. So I think CSE Global is I know there's a bit of a litigation, so the share price got sold down, but it's generally going to do well because it's basically riding on the trend of electrification in the US. What has happened is that as more EVs the US add on more data centers, more EVs, a lot of the power system, the whole infrastructure and grid, especially the substations, need to be upgraded. So that's where they are riding on that particular trend. Yeah. Hi Paul. Well, it's 1 week to Trump's inauguration. Do you see him announcing anything shocking? Like we mentioned, I'm just watching what he's going to say on China. The usual thing there'll be, like we mentioned in our strategy, will be migration, it will be tariffs. I'm not, and the ability to cut taxes, that could I'm not sure how much he can do that because right now the bond markets are very nervous. So that could be a restraint too. I'm not sure, nothing can restrain him, but there's something to monitor. For me, it's just the fiscal position and also the tariffs and of course China. So if he imposes tariffs on China, but again everyone also has similar tariffs, then it's like I said, it's a de-risking of China exposure to the US. I mean, there was worrying that there would be some very punitive. Okay, I'm so sorry we can't answer the lots more TA, but I think Zain has a TA session at 8 p.m. So you can post some of these questions there. Without taking any more time, I'd like to thank everyone for your time. I hope it was useful and hope to see you next week. And I wish everyone have a wonderful week ahead. Thank you, everybody, and take care.